Welcome to Business Buffet, the Help Yourself video series, bringing you fast food for thought. Info you can really sink your teeth into. For best results, first review the program without doing the exercises, and ask yourself the questions in the notebook introduction. Then, zero in on each section, doing the exercises as you go. Here are some of the characters you'll be meeting. You with a business idea. Your competitor with a different idea. Your product or service. Your supplier. Your prospect. And your customer. When you hear this and see this, it's your signal that there's something to do. Have the notebook handy and jot down the ideas you get. After reviewing the whole series, your notes will be a valuable resource. As you plan and grow your business, watching again and again will stimulate fresh insights and creative solutions. And by inviting others to watch with you as a basis for discussion and brainstorming, you can benefit from their ideas too. Now, let's take the fear out of finance. Welcome to Bookkeeping. By the end of this program, you'll be able to enter debits and credits, describe the bookkeeping process, and use the information to create financial statements. You're in business and things are hopping. Orders coming in, clients being served, invoicing, deliveries. Bookkeeping? Later. With hundreds of transactions each year, imagine how many receipts, invoices, and other source documents your business can accumulate. Some people file them regularly and diligently so they can refer back as they track their progress. Other people stuff them in shoeboxes. What do you do with them? Running a business is like juggling, and bookkeeping is the balancing act. It's a systematic way to organize financial information so you can actually use it in your business. A ship might never reach its destination without nautical gauges. Without financial gauges, how can you reach yours? Can you plan profit strategies? Can you plan at all? Unless your data is current, you're working in the dark. This video unlocks the mysteries of bookkeeping, how it works, and how it feeds information to your financial gauges. Without current information, your tools are obsolete. Time is money, so let's get started. Business activity is about decisions and results. Just as every action causes a reaction, every business decision causes a result, moving dollars out of one area and into another. Each transaction is represented as a debit and a credit. When all transactions are double entered this way, total debits will equal total credits. There should be no mystery about the debits and credits. It's a way to cross-reference your activities so you can balance your books. For the system to balance, some accounts are called debit accounts, while others are called credit accounts. If your figures don't balance, you know you've missed something, and you can retrace your steps by matching debits with credits. The system is simple, but the terminology can be confusing. When a decision involves a credit account, you show increases with credits and decreases with debits. If it's a debit account, though, you increase it with debits and decrease it with credits. The handy reference in your notebook will help you as you do your bookkeeping. Transaction details are first listed in journals, as they happen by date. Say you have your car serviced and you pay by check. Which is the debit and which is the credit? You increased expenses, and expenses are debit accounts, so debit car expenses in your journal. At the same time, you reduced your cash asset to pay these expenses, and even though it may not seem logical, assets are also debit accounts. Credit this account to reduce the asset and balance the transaction. So a journal is like a diary, tracking your business activities. But a daily journal is not much help if you need to know how much you've spent on office supplies, or what's owing on a particular account. For this information, you need to group transactions by account, like sales, car, rent, insurance, and so on. You'll need a chart of accounts, a list of accounts for your business. There are 5 account types. What your business owns and uses to generate sales, like car, equipment, and cash. What you owe, bank loans and payables. What you have, retained earnings and shareholder loans. what you sell, sales and rental income, and what you need to operate, like rent, office supplies, utilities, and don't forget your accounting fees. Take a few moments to prepare your chart of accounts. Then complete a balance journal for yesterday. Pause while you write, then press play to continue. With your journals completed and balanced and your chart of accounts, you're ready for the second phase of the process, the ledgers. The general ledger, or GL, contains an individual record for each account, a summary of all transactions by category. Each journal entry is transferred or posted to the related GL account, debit items to debit GL columns, and credits to credits. Check each item as you go to make sure you transfer all of them. Then calculate the new balance for each GL account. When the posting is done, the GL should balance too. If it doesn't, did you enter something without offsetting it? Did you skip an item as you were adding? With so many numbers and so much detail, a calculator with a printout will help so you can review your figures. Remember, the accounts must balance. Take some time to post your journal entries in the general ledger. Pause while you write. Press play to continue. What about your monthly bank statements? Do they ever balance with your records? Even if you've listed all transactions, there's usually a difference. Why? Some GL entries may not yet be reflected in the statement, or charges and loan payments not recorded in the bookkeeping system. Then again, you could have made an error somewhere. To make sure you and the bank agree on how much money you have, you need to do a bank reconciliation. Match canceled checks with journal entries. Then list any outstanding records, interest, service charges, loan payments, pre-authorized payments, and uncashed and returned checks in the appropriate journal, and post them to the GL so it's still balanced. Now you have the information you need so your accountant can prepare your financial statements, the third phase of the process. It begins with the worksheet. It's a fact that all financial records must match the right financial period, but some situations aren't clear-cut and need clarification. To recognize the impact of these special situations, your accountant uses the worksheet for year-end adjusting entries. For example, if a customer prepays, the amount is applied to the period related to the payment. And if you buy insurance halfway through the year, you're prepaying half of next year's premium, so an adjusting entry is made. Depreciation divides the cost of a fixed asset over time for tax purposes, and the amount is entered at year-end. What if inventory is obsolete or stolen? Year-end inventory must be counted and compared with the year's opening inventory, so you can adjust accordingly. And what if you made a sale and couldn't collect? For a true picture, you have to adjust for uncollectibles. But never give up on your customers. They could surprise you one day. After all adjustments, take a trial balance to make sure your GL is still balanced. Now account balances can be separated into the balance sheet and the operating statement. Asset, liability, and equity account balances are transferred to the balance sheet section, and revenue and expense balances to the operating statement section to show the relationship between your operations and their results. Financial statements contain crucial information you could be using during the year, so prepare an informal set quarterly or even monthly. To get ready for next year, revenue and expense accounts are closed to zero, and the difference reflected in a temporary income summary account. The balance in the income summary is your profit or loss for the year. If there's a debit balance, credit the summary to close it, and debit retained earnings. This reduces your equity. Time to plan profit strategies for next year. A credit to retained earnings means profit. Of course, where there's profit, there's tax. So calculate the taxes payable, debit them from the income summary, and credit income taxes payable. What's left in the income summary is yours. Debit this account to close it to zero, and credit retained earnings. You've now increased your equity. Fantastic! But wait! Before you decide how to use your profits, could this success be too good to be true? With all this crediting and debiting, you'd better take one last look, a post-closing trial balance, just to be sure. Now you've completed the bookkeeping process for the cycle. Congratulations! Your records are ready for the new fiscal year. Are you? Bookkeeping may not be glamorous, but it can keep you in check, so let's review. Daily transactions are first listed in journals, then transferred to account ledgers, and these account balances are separated into the financial statements, your keys to planning for profit. So stay on top of things, even if you must hire someone to keep your records up to date. Remember, shoe boxes are for shoes. Now that you can enter debits and credits, describe the bookkeeping process, and use the information to create financial statements, use your gauges regularly and consult your financial advisor before making major business decisions. This has been part of the Business Buffet Help Yourself video series. Business Buffet, helping small business help itself to profit by making business learning fun. If you enjoyed this overview, you'll want to know about the other exciting products and services specially created to help small business help itself to profit. For information on the growing list of Business Buffet products and services, and to be placed on our mailing list, contact Business Buffet and help yourself to profit. Thank you.